Okay, we're going to get started by looking at the S&P 500. You can see that since last week, we're break even. We went up a little bit and we're down a little bit. But you can see that we're in a downtrend and we're basically rallying. We had a big drop on the proclamation day, the tariff announcement day. And we went up uh, soon after, but we hit this line of support. So we're basically in a downtrend and we're just basically making lower highs and lower lows right now. And you can see that probably we have two choices here in the S&P. We can either go down to this trend line. A lot of times when there's a big drop like this, the market wants to retest the low that it made right here. So you can see that we have 5% or so to go before we get down to that spot. If we do get down to this 4,900 level that we got to during the right after the tariff announcement, and we bounce, then that's a good sign that the stock market has successfully tested its low. But we have a lot of intangibles right now that's hurting the stock market. A lot of unknowns, and this is all self-inflicted wounds, as they say. You can see based on the news in Yahoo Finance, you have the world is like reeling, trying to deal with these tariff announcements. You have a trade war between the United States and China. You have a potential US dollar um, problem around the world. Right now, the US dollar is going down and it's losing its value. Um, we have price surges. They're supposed to be coming because of the tariffs. That's going to cause inflation. And the Fed said this week that they're not going to bail out the stock market. Um, Usually, when there's inflation, the Fed tries to raise interest rates to stop inflation. So the Fed is in a bind. We have people around the world anti-US, not buying US, not visiting US as a tourist destination. We have a lot of things that the United States is basically screwing up that could affect the profitability of the companies we're following. So let's look at, okay, so right now it seems like the trend is lower highs, lower lows. Our next stop probably is down here in this chart. You can see the QQQ is almost identical to the SPY. This is the SPY. Let's look at the QQQ. This basically traces the tops and the bottoms of this chart, and it's basically looks like it's lower highs, lower lows. I like to look at things a little bit differently. Whenever we have a sell-off like this, we wanted to see what babies are thrown out with the bathwater, and we want to see what stocks could be um, immune to the problems, the geopolitical issues, and the tariffs. All right, so you can see we're just pointing down for the opening starting Monday. Let's look at, let's look at some of our talking points. Okay, so we're getting ready for earnings, one of the biggest weeks of earnings season. And you can see based on what's happening here, this 100 of the 500 S&P stocks are reporting this week. These are the biggest ones, the most important for us. We like to look at the ones we're following. We have Verizon. They're on Tuesday. that'll give us a hint of um, Verizon is an example of a stock that's kind of immune from tariffs because most of their um, business activity is in America. Same thing with AT&T. They're a domestic company and they pay a big dividend. So both of these are basically in uptrends, and there's going to be a lot of people gravitating towards safer stocks in an environment where it's really hard to get any kind of return. You can see that we start the Mag 7 earnings with Alphabet on Thursday. We have AbbVie coming in with the earnings on Friday. So um, the next couple of weeks, we're going to have a lot of earnings come out that could make or break the direct trajectory of the S&P 500. So you can see, we're in a downtrend here, but if we have some really good reports, we might break out of this downtrend and make some go back to our moving averages, which um, could be possible with some good earnings reports. We're going to look at the other side of things. We're going to try to find some good stocks that are kind of immune from um, the tariff things that are happening and the negative sentiment in the stock market. Okay, so let's look at some of our talking points from this week. Okay, so we were talking about last week examples of stocks that work now. Okay, these are USA based stocks and stocks that pay a dividend and aren't involved with tariffs for the most part. We have Verizon, they're coming out with earnings on Tuesday. Kraft Heinz, they pay a 5% dividend, and there's a steady demand for food in good times and in bad. We have Philip Morris, they sell cigarettes around the world. We have Kroger, they're a US based supermarket chain. We have Conagra, they pay a high dividend and they are food based. And AT&T, AT&T is a domestic telecom company. T-Mobile is based in the US and they're an example of a growth company that's not tech. And they're becoming one of the largest in the world, in one of the largest telecom companies. And Netflix, we talked about last week. They just came out with earnings and they were better than expected on Friday. And it's an example of a stock currently it's not affected by tariffs. It's they're growing around the world and they have a trajectory of growing around 20%. So we're going to go over Netflix later on in today. Okay, so let's look at our themes from this year. Our themes are revert to the mean. We have healthcare, telecom, financials, energy, and utilities did worst last year, and we expected them to do better this year. The S&P at the beginning of this year was 24, and over time it'll revert to 2015. So if it goes down to its historical average of 15, that'll be down 20% from where we're at right now. So don't be surprised if the S&P does go down 20% from where it's at. We're absolutely losing momentum. We have most of our moving averages moving downward. So if you can see these moving averages, see right here, a lot of them are starting to move. This is the 50-day moving average. It's moving down, and 100 and the 200-day moving averages are kind of flat line, almost moving down. What that is that's a sign of momentum. And when we lose momentum in the stock market, um, it takes a long time to get back into this beautiful range we've been in for 2 years, 3 years. So right now, that's the situation. Let's look at some more of our meeting notes. Okay, so companies that do great in this environment, USA-based companies, we already mentioned a bunch of these that kind of don't have to do anything with tariffs. We have companies where earnings estimates are increasing and companies that did bad in the past year, couple years, and a reversion to the mean. Okay. We also look for low PEG ratio stocks. Um, in our screen, we want to look for stocks that are undervalued. Let's skip real fast to one of my talking points. Hold on, it'll be worth it. Okay, Fidelity Contra Fund. Okay, whenever I see a market correction like we're in right now, I like to review some of the top holdings of some of the best mutual funds in the world. Contra Fund is one of the best over time that I can see. And let's look at what their top 10 holdings are right now. Meta, 17% of their holdings. So if Meta actually drops in this environment, I would be inclined to start accumulating it, because a lot of times every stock drops, whenever the stock market is crashing. These are the stocks that I think, you know, um, are high quality and you can buy and hold for a long time. Let's look at some of these stocks that are in here that are kind of immune to our current environment. And if we see any drop in the stock prices of these stocks, we want to circle around. Okay, so Berkshire Hathaway, they have $325 billion in cash right now. They sold at the market highs last year, and they're waiting for a market correction. And they're USA based. They own a railroad, they own Geico, they own domestic companies. And of course, they have some things that some of their input for their companies, are going to be taxed by tariffs. But for the most part, a majority of their revenue is from America. So they would, if Berkshire corrects in a major way, I want to go look at that one. We have Eli Lilly. They have a weight loss drug that is the best in breed. They also have a a weight loss pill that was just tested and it's better than Ozempic. And that is the holy grail for weight loss right now. Even if someone does take Ozempic, they might take a pill for a couple more months just to keep the weight off. So a lot of people are avoiding shots. And if Eli Lilly does come out with a pill for weight loss that's effective, that could catapult this company. Netflix is another company that's it's multinational, but they're not affected in any way by tariffs or by the current geopolitical situation. Even if there's a depression, people won't give up their Netflix subscription because of its cost added value. So if you pay $20 a month for unlimited video for your family, that's going to be the last thing that people give up. So we're going to go over Netflix a little bit later on. Um, of course, we're going to keep our eye on all the other stocks in their top 10, like Microsoft, NVIDIA, um, Amazon, Apple, and Alphabet. Um, so, so as we don't know, we don't know where the bottom is for this downtrend. We don't, we, it's not a good idea to try to play catch a falling knife, they call it. That means stocks are going down in a major way. You don't want to be a hero and try to put all your money in at one time. What you want to do is you want the dollar cost into different positions that you're interested in. For instance, if we have Meta, for instance, and it's going down. You put, you know, um, small amount into each one you're really interested as it becomes more attractive to you. And and you hope it goes down more so you can buy more. Um, and we're using peg ratios to really determine the values of stocks. So, okay, let's go back up to our talking points from the beginning. Okay, so currently we're actually overbought, just slightly overbought at 57, and we're starting to go down. But you can see we're actually going up to this trend line to the penny in the QQQ and the SPY. And then we're like making another huge drop down. And that's the trend. So we have to deal with that. And okay, so this is an example of a trend line that goes back to the COVID lows of 2000. You can see if we go back 5 years, we trace the bottoms and the tops of the S&P 500. The correction we had on April 10th went down exactly at a penny to that trend line. So that could give us some support for the S&P 500. So if we're looking at this um, downward channel, we have support right here going back to the COVID lows. So if we retest that right there, there's a good chance we could bounce. But if we do and we go there and we go back down here, then you can that 5-year trend line doesn't work anymore. Okay, so now let's go back and look at the 10-year Treasury. You can see that lately it's been going down, and the stock market's been going down with it. We had a big scare right here where the Treasury went up a lot in a short amount of time, and it seemed like there was a lack of confidence in the U.S. Treasury market. Um, but there could have been a forced seller somewhere in the market. We don't know. Um, okay, so now we have the price of oil is still really low. It was 59 last week. Now it's 64. But in general, our our theory is slowing economies around the world. If there is, the price of oil goes down. So there's a lot of smart people saying the price of oil is going to go down. So any oil stock that you own, you got to realize it's at the mercy of the price of oil. So these tariffs, this is like an experiment to the global economy. Whenever the president announced tariffs on every country, that basically has screwed up the business model for every country, and we don't know um, how trade is going to work in the future. We don't know what countries aren't going to be dealing with us anymore. We don't know the cost of goods sold for majority of companies around the world. Everything is it's like throwing a monkey wrench into a Formula One engine. We had a well-oiled economy in America for like 100 years, and all of a sudden we're throwing a monkey wrench into everything. We don't know how it's going to work out, and that uncertainty is causing the stock market to lose confidence, and that could cause the price of the stock market to go down. So, okay, so now we have inflation isn't changing a whole lot, but we do have tariff pressures, and that could cause inflation to go up. According to the Fed, they've mentioned that this week. The dollar index continues to go down. It was 98 this week. So the dollar is losing value. As our theory is a stronger US dollar tends to drive gold prices lower, but a weaker US dollar tends to drive gold prices higher. So gold is continuing its uptrend. It's up another 3% this week. The one issue with gold, if you're thinking about buying gold, um, it's one of the best charts in the stock market. It's up 20% this year. Um, we'll go over the gold chart a little bit later. But the interesting thing about gold is theoretically, that this weakening dollar should make gold prices go higher. But if there is a massive sell-off in the stock market, so if we're looking at this chart and we see another massive liquidity crisis where have to sell, we have a lot of people betting 2, 3 times funds. There are funds that allow you to bet 2 to 3 times um, on securities like Nvidia. And if you have to bail out of these things, you can have a massive liquidity event. And if so, people will have to use their gold um, to bail them out of some of their riskier trades. So if there's people have margin calls, then you're going to have um, some. You're going to pick from your winners to bail yourself out of your losers, and that's why gold um, might go down in a market sell-off. So keep that in mind. But theoretically, gold should continue to go up with all the uncertainty with the United States dollar, with the United States tariffs that are happening. So keep that in mind. If you have a spike lower in gold, it's because of that. Um, People have to sell their winners to fund their losers. All right. So, okay, dollar is definitely in a downtrend. Very supportive, high commodity prices. And it's helping the multinational companies. Like Netflix said on their earnings report on Friday that they were helped by the US dollar. So every company, probably all the tech companies like Alphabet and Meta, they're going to be helped. Probably their earnings are going to be better by 3% or more because the dollar has gone down so much. Okay, so let's look at the fear and greed index. We're still at extreme fear. We have maximum pessimism in the stock market. And as the stock market continues to go down, we have a fearful, we have less fearful than last week, but we're still fearful. Um, and the AAII survey is still bearish. This is the most bearish number of weeks in a row for this survey, probably of all time. And the last time we were this bearish was the financial crisis in 2008. So that is a contrary indicator. Right now, I'm keeping my eye on the prize, looking for the quality stocks that are in the top 10 of mutual funds. All right. So, all right. So let me see. The next thing we have to say, the VIX. VIX is 29. That's pretty high. We're still in a fearful mode. People are buying protection and preparing for some kind of crash. We had maximum maybe 50 VIX right around April 10th during the tariff announcement. Um, and usually when there's a higher VIX, that's basically the time when a lot of good investors start looking for something to buy. We are definitely in a capitulation mode right now in the stock market. We've had, let's see, we we are in super fearful mode. Probably right now we haven't gotten to despair yet. Maybe after we hit this double bottom in the stock market, we'll have maximum despair. Um, but you gotta realize whenever people are most fearful, that's the time when the best bargains happen. And um, there's a saying that when it comes time to buy, you won't want to. Um, so the best time to buy stocks is when everyone else is fearful. So let's look at some of the issues that may lead to a crash. And we've been saying this for like years, and it's starting to, some of these are starting to have happen. AI stock bubble bursts. So we have a lot of hints around NVIDIA that there are issues with orders. They had a $5.5 billion um, problem that they pre-announced because the government is restricting their sales to China. So there's a lot of geopolitical issues that are going to hurt these companies as investors. We can't predict that. Um, but it's one of the things that could lead to a lack of confidence for the Magnificent Seven stocks. So we have we have a 40 to 50% chance of the US going into recession. We have massive layoffs and reduction of spending by the government. Um, we have every day, we might have a different announcement by the president. Oh, we have a 500% tariff on China, maybe? Okay, so that's causing volatility and a lack of confidence. Um, so right now, we're in this fearful stage leading to a capitulation. All right. We've been saying this for a couple of years now. The PE ratio for the stock market right now is 21. The last time the yields were at 4.3, the PE was 16. And that's 20% less than now. So if the S&P has a PE of 16, it trades at 4,200. That's 20% less than where we're at right now. So it very well may be that we're going to go down 20% in the stock market, but that brings us to a fair value. All right, so let's look at some of our worst to first. At the beginning of the year, last year we had communication services, IT, consumer discretionary up the most. Now they're actually down the most. We can see the ones doing the best are consumer staples, utilities, real estate, and healthcare. So that actually was the worst performing from last year. Right, and okay, our theme from last year. Hold on for a second. Okay, our theme from last year was um, interest rates were going down. Investors will be reaching for stability amid chaos. Investors preparing for the slowdown in the economy. So the idea was to buy stable things, healthcare, utilities, consumer staples. Um, right now we had a week, hold on for a second. Okay, okay. So we have a weak dollar. Whenever there's a weak dollar, companies overseas will be positively affected. Overseas markets will tend to outperform. Input price of goods from overseas goes up, and the price of commodities go up. So we've seen gold go up, but we haven't seen oil go up yet. So you see, okay. Now, all right. The other theme was AI growth tapers this year. So we've seen a hint from NVIDIA that there's not as much demand for some of their products. Um, so the whole AI growth story, we're going to find out more this week from the big tech companies of how they're spending, and that could help us understand the AI growth story. Okay, consumer staples is the best. Utilities real estate, healthcare, materials, financials. Okay, so those are the best sectors this year. Let's look at some of the stocks that are going up the most and down the most. Okay, we have Eli Lilly up 14%. They had a good news on their pill for weight loss. I'll go over that a little bit later. We have these things. Most of these stocks are tariff affected stocks. We have Dollar Tree. Just think they get 90% of their products from China. They have to pay a 145% tariff. How are they going to keep their price at $1.25? I don't know, but they're up 8.1%. We have Nike. They're totally affected by tariffs with most that are shoes made in Vietnam. So I'm not sure why they're up today. The ones going down the most, United Health. This is stock we've been looking, and we saw this in a lot of growth portfolios for the top 10 in mutual funds, but we were never sold on it. I think one of the biggest problems with United Health Group is the inconsistency of how people use their healthcare. So during COVID, there was a big lack of use of healthcare because there was it was an emergency. So you can't go for a hip replacement if it's not an emergency. During COVID, you only had doctors available for emergencies. So people put off their operations, and now what's happening is they have a lot more operations to pay for all at once, and they totally missed all their numbers. So so this is getting a little bit sketchy. The quality of their earnings isn't as good as some of the tech stocks we're following, and the consistency of their earnings. Um, let's look at global payments, Humana. So whenever one stock in the sector goes down, like United Health Group, a lot of the other stocks like Humana go down with it because um, a lot of stocks go down in sympathy, they call it. All right. So that was a good little exercise. Let's look at the stocks going down, up and down the most. First of all, let's look at the 10-year. We always like to look at the 10-year where it's going. The 10-year, it's basically in a downtrend. You can see it's going down. So this our cheat sheet for yields of the 10-year going down. That's positive for small caps, high yielding stocks, home builders, speculative. Okay, let's see if that's happening today. In our top sectors. Okay, oil is going up. Oil services. Okay, and oil, gas exploration. So that could all be because of the price of oil. Let's look at the pre-market, see what the price of oil is today. Price of oil is 63. It's going down a little bit. So, okay, we can't get anything. Okay, so I don't know why the price of oil is going up. Maybe because the US dollar is going down, but let's look at other things. The consumer staples is going up. Okay, so we have a flight to safety. Um, so our theme from the beginning of the year has been stocks that pay dividends that are steady eddy and are going to be stable growth in good times and bad. So we have energy, we have retail, we have consumer staples. So consumer staples, they're stocks like Procter and Gamble that sell you toilet paper and Tide. Home construction. Okay, that makes sense. As the price of the interest rate yield goes down, there's a higher demand for home home construction, um, home builders, real estate. Okay. So basically, if we go back to our um, themes from the beginning of the year, steady Eddie stocks, healthcare, utilities, consumer staples, they're basically outperforming now. Real estate, okay. So these are all stocks that do good in a declining interest rate environment. And the ones doing the worst, gold miners, semiconductors, healthcare, select, and technology. Okay, so okay, that's all I can get from that. Let's go back to our talking points here. Okay, so Dan Now's picks from the beginning of the year, most of them are negative. We have negative 10 at ADTN, negative 10, negative 6 for Cisco, IJJ, negative 11, banking ETF, negative 13, cash, his best selection is up 4%. So it's yielding 4% cash right now. Um, so that's been his best idea. Let's look at a chart here from every 10 worst single day percent declines for US stocks. This is really good to watch. I pin a copy of this to my desk. Warren Buffett also does too. Warren Buffett has newspaper clippings of the worst days in the world of investing. He waits for days where there's negative 20% declines. And you can see the worst Black Monday, negative 20% one day decline. We can't have negative 20% anymore due to circuit breakers. But 1 year after that crash, we had a return of 23%. Return after 3 years, 11.59%. Return after 5 years is 13%. So you can see almost every one of these crash situations. Um, 1 year later, it was almost up 20% every year, except for the global financial crisis in 2020 at 2008. But you can see um, that we did have we did have a small amount of time where we had 15% decline in the stock market, and we did see a quick reversal of that. But in general, 1 year after each of the S&P 500's 10 worst one-day drops, the index reached double-digit positive returns in all but one instance, the Great Financial Crisis, and remained positive 3 to 5 years later too. So the chart includes dividends, and so this is a really good thing to look at, clip, and keep to your desk, and know that Warren Buffett waits for days of negative 20% for him to start buying things. Okay, here's a little chart by Ross Brown. He mentioned just what I was pointing out, that there's an uptrend from the COVID lows. So you can see that we're still basically we hit the absolute to the penny this uptrend for the S&P. So there's a lot of support at the April 10th lows. And if we break through that, we don't know. It's a big question mark. Um, okay, here's some charts of interest. We've already talked about the S&P, and the NASDAQ is very, very similar in a downtrend. Let's look at AT&T. AT&T, domestic company based in America. Most of their money comes in America. So they're actually overbought right now, and they're continuing to hit near all-time highs, and they're in an uptrend. And you can see Colgate Palmolive, they sell dishwater soap and toothpaste. So that's constant demand in good times and bad. They're basically in a trading range, and they pay a dividend. So that's an example of stock that works now. And they're mostly American-based. And Procter and Gamble, you can see that they're in a well-defined um, trend line area. And you can see that they pay a dividend and they're overbought right now. So they're an example of stock that's a steady stock that will do good in good times and bad. Here's Visa. Um, let's think of how they're affected by tariffs. Um, they're basically they own a large portion of the worldwide credit card market. There is a big push by other nations um, to use technology that's not American. So there's a big anti-American push. There's like, for instance, in Europe, they're trying to get Europe to go on a different standard for credit card usage. So that could affect Visa in a major way. Um, but right now, in good times and in bad, people buy things with their credit cards. Let's look at waste management. They're an example of a stock that's pretty much in a confined range here. They're starting to break out, and let's think about how they're affected by tariffs. 99% of their money comes from America, and if there is a depression or a um, recession, people still make the same amount of trash. So, and they can still raise their prices. So it seems like they're insulated from a lot of the problems in the world right now, and they pay a dividend. Let's look at Berkshire Hathaway. I was mentioning earlier, it's one of the safer stocks. They're America based. Most of their money comes from America, and they have 325 billion in cash. They can pounce on stocks if there's a crash in the stock market. So that's all really good. Another good thing about Berkshire Hathaway, they're going to have a well televised Berkshire Hathaway event in May, and that's 1 month away. Um, well, actually less than a month away. So that could be a catalyst for this stock because every investor in the stock market looks up to Warren Buffett, and um, and his annual meetings in May are a big cheerleading for the stock market. So and that that could be a catalyst for the stock market going up. If Warren Buffett says anything about stocks are inexpensive now, or he probably won't, but if he mentions something about what he's buying, that could make stocks go up 20%. So we'll keep an eye on Berkshire Hathaway, but if it sells off with the market and it goes down to the bottom of this trading range, I would be definitely looking to buy it there because it's one of the safest, most diversified stocks that I know of in America. Um, NVIDIA, this beautiful uptrend was broken right there. We are starting a downtrend for NVIDIA. You can see that. They're going to have the earnings later on in May. Um, it's going to be a month or more before we get their earnings. Um, but they're giving little hints that there could be a lack of demand for some of the processors. The United States is limiting what they can sell to China, and that caused them to say that they have a $5.5 billion impairment. So that the current geopolitical issues are definitely affecting the NVIDIA stock. Um, so we'll see what happens, but it's going to be a month or more before we find out about their earnings. Eli Lilly, you can see we've been following this stock for months. They had a 14% gain on Friday. Um, you can see that they have like a well-defined trend line. It's kind of sideways right now, but you can see that you can see that they barely went up to their moving average, which is the 200-day moving average. Now, this is an example of a stock that basically follows the S&P almost to a T. So as the stock market goes down, this stock goes down with it, regardless of its how good its stock is performing or how good the fundamentals are. So if I see this stock going down with the stock market, I'm going to start dollar costing into it. It's about fairly valued. We're going to go over it a little bit later. It's about fairly valued now. It's growing at 30% for the next couple of years, which is pretty amazing. And it's not a tech stock either. So if you want diversification in your portfolio, this is a good stock to start looking at if you're a growth investor. Costco, you can see that, it continues its uptrend. They have 99% renewal on their memberships, and they're increasing their membership fees. And whenever there's good times or bad times, if there's, a recession, people are cutting back, they're going to go to Costco and buy a 500-pound pallet of rice. So let's look at T-Mobile, another example of a US based, 100% US based company that has become the largest telecom company in America. And they have probably the best service, the best product. So, and they're taking market share. But they don't pay a dividend, but they're an example of telecom companies are kicking it right now. And you can see that they're making almost an all-time high. So, but they're overbought right now. Um, let's look at gold. As I've been mentioning, as the United States dollar goes down, usually commodity prices go up. And gold's been on a roll. It's up 20% this year. The one bad thing about gold is because it's a winter, whenever there's margin calls and people have to sell some of their losers, they're going to sell their gold to pay for the losers because gold is the best performing thing this year. And if you see a spike lower in gold, it's mostly because people are funding their losers with their winners. But it seems like theoretically gold is one of the best um, hedges for your portfolio in this crazy environment of tariffs and unknowns. But you got to be ready for a big drop, if there's a crash. And you would think people would go to gold, but people might have to sell gold to pay for margin calls on other items in their portfolio. Netflix, you can see this is one of the only last remaining tech stocks, a Mag 10 tech stock in an uptrend. And it gave great earnings report this past Friday with great visibility. You can see they're super overbought. So probably on Monday it'll be up to here, but it's in a trading range, it's in an uptrend, and any market pullback, this would be a good stock to diversify, and they're probably one of the only 11% returners during this period of craziness. So in a market downturn, it'll go back down to this trend line about right here, and that would be a good time to buy it. But in general, you have to think about Netflix and most of their customers are in America, but they're diversifying across the world. They sell a product that costs $20 a month for unlimited entertainment on the TV. That people will not sell that even if there's hard times. So that's why they can predict, with such certainty their earnings in the future. And certainty is what gravitates investors. That's what gets people's attention. But if the stock market sells off, this will go down with it. but you got to realize it's more consistent and more predictable than other big tech stocks. I did a stock screen this week. I found our typical stocks that we've always seen at the top. I thought it'd be interesting to go over Eli Lilly and go over Netflix. They've been in our top 10 for a long time. Um, other notable stocks here, T-Mobile, and what other good ones are in here? Okay, those are the ones we're going to focus on right now. Okay, um, let's review again. Fidelity Contra Funds, top holdings. Um, Meta, they own 17% of their portfolio in Meta. Berkshire Hathaway, this is a new large position for them. They just increased their position in Berkshire Hathaway a lot. We see Eli Lilly and Netflix, 3% positions. So we're going to go over Eli Lilly and Netflix. So Netflix, you can see by their profit margin is 27%, 23%. Just think they pay for, they spend money on new content. So they make new movies, they make new TV shows, and they spent a lot of money in the past making these TV shows. Now they're actually spending less money, but they're running the reruns. So they're actually starting to be more profitable because they're spending less money over time in creating content. The return on equity is 40%. That is amazing. That's 3 times what we're looking for. Um, they have more. They have about 9 billion in debt. If you take out their cash, subtract it by their debt, can, for a market cap of 416, that's chump change. And they have $21 billion in cash flow, which is just amazing. So, so this company is in a good spot. You know, they have, and they're raising prices every once in a while, and people aren't leaving. So they have price um, power, and they're growing around the world. I think a third of their content now is in different languages. So, so anyway, it's that's a really good stock to look at whenever the stock market is selling off. Right now, it's at like an all-time high, but it will come down with the rest of the market when everything comes down. You can see based on the earnings estimates, they're growing around 20, 22 or 20%. So let's say they're growing at 20%. The PE, forward PE is 39. So that means their PEG ratio is about 1.39. That means they're overvalued, but they've always been overvalued. So in the past they've been like 3 or 4 times overvalued. Now they're a little bit more reasonable. Um, the great things about this company, they're one of the only growth stocks that we're following that's not affected by tariffs yet. Not yet. Maybe other countries might tax this somehow. I don't know. Not yet. They gave great positive future guidance on Friday. There's not a lot of companies that are giving forward guidance due to the tariff situations. Um, Negatives, they are overvalued, but it's always traded expensively. So, and they are a leader in their industry. There isn't a streaming company better than them right now, and they have market share. So, and they have pricing power. So, all in all, this is a decent stock, but you have to wait for it to come down to the bottom of its trend line. Here's a story that came out. Daily pill may work as well as Ozempic for weight loss. Um, okay, hold on for a second. Okay, so so basically, Eli Lilly has a pill in in trials that showed that it's it's safe and it's effective as their competition, Ozempic. So basically, if people are on Ozempic now and they're sick of taking that shot, or if they don't like taking the Eli Lilly shot for um, weight loss, this could be a pill that they take after that to keep them from gaining weight again. So everyone's been waiting for a good pill for weight loss for a long time, and this is huge news for them. But when the stock market sells off, everyone forgets about the good news of a stock. It sells off the rest of the market. So let's look at Eli Lilly's chart. You can see that, on that news, it went up to its 200-day moving average. So it's in the trading range right here, like that. Um, in a bad market, it'll trade again back down to the 723 range. So keep an eye on this as a stock that's growing. Right now, they're not affected by tariffs, but um, so it's growing around at 29%, and the PE ratio is 36. So they're only about 25% overvalued right now. The great thing is um, they're not affected by tariffs yet, but there's a threat that if they make some of their money in Ireland or some of their pills in Ireland, they might have to pay tariffs, and that hasn't happened yet. They haven't taxed the drug companies yet, but that could happen. As soon as that happens, there it very well may go down to this bottom of this trend line or less or more. So you have to be ready to buy it once it goes down there. And the valuation measures. You can see the PEG ratio according to finance is 1.22. That kind of matched our estimation of 1.24. Profit margin is 23%. That's awesome. Return on equity is 7 times what we're looking for at 84. They have more. They have 34 billion in cash. That's not a whole. I mean, in debt, that's not a lot for a 750 billion dollar company. And the cash flow is 1.32 billion leverage free cash flow. So they put a lot of money back into the company to do more production of their weight loss pills recently. So that's why their cash flow isn't as good. But they're going to have more product to sell than any other company for weight loss. And that's why they're going to be continuing to do really good. Okay. So, all right. That's all I had to say for today. I hope you had a really good time watching this, and I hope you have a good week ahead. If you have any questions, let me know, and I'll try to answer them. Okay. Have a good week, everybody.